A very good day to our lecturer, Dr. Hui. Today our group will be presenting on the analysis of Top Glove Corporation Berhad. So the chart shows the cash flow by activities of Top Glove throughout the 5 years. And the table above shows the net cash flow of Top Glove Corporation's Berhad in 2015 had increased to 96.386 million from 80.377 million in 2014, and it also projected a continuous decrease to negative 71.346 million in 2018 since 2015. So the proceeding slides will be presenting on the cash flow by each activities of Top Glove.
Hi everyone, I'm Kho Jia Rong. Now I will introduce operating cash flow. Here we can see there's a increasing and decreased trend over 5 years. A year 2016, there is a significant increase about 29%. It's because of the increasing in receivable and other current assets about 83 million and 27 million. And for the next year, there's a slightly growth about 10% each year. A year 2018 is because of the increasing of interest paid and buying inventory for the company.
Coming to the investing cash flow of Top Glove, it projected a negative cash flow over the 5 years. The negative cash flow has increased from 260.301 million in 2014 to 501.843 million in 2015. This is due to the value of cash outflow of purchasing investment securities, which is amounted to 434.114 million in 2015, is double the value of 2014. Under the investment securities, there is significant increase in the available for sale AFS financial assets in 2015, which increased significantly by 447.66%, resulting from debt securities that is quoted outside of Malaysia. Based on the accounting policy of Top Glove, debt securities in the AFS category are intended to be held for indefinite period of time and that may be sold in response to needs for liquidity or in response to the changes in the market conditions. Furthermore, the value of cash inflow from proceeds of disposal of investment securities in 2014 is 216.256 million as compared to 47.018 million in 2015, which is higher in 2014 by 359.94%. So both of the purchasing and the disposal of investment securities has caused a huge difference of 381.325 million between the year. So besides that, the cash outflow from investment activities have a significant increase in 2018, which is about 10 times of 2017. This is because of the huge cash outflow of 1,270.542 million on the acquisitions of subsidiaries occurred in 2018 has led to a unquoted shares purchased by Top Glove in 2018 had increased to 1,020.077 million, which is 22.66% higher than 2017. Top Glove had acquired many subsidiaries in 2018, and the effect of acquisitions of Eastern Press, Aspian, and Dura Medical had caused the net cash outflow of 46.171 million, 1,231.211 million, and 3.16 million respectively. By acquiring the subsidiary, goodwill from acquisitions of subsidiaries amounted to 1,281.691 million had been allocated to cash generating units, GCUS, which is determined based on value in use calculation using cash flow projections on financial budget approved by management of Top Glove covering 5 years period.
Now is a financing cash flow. Here we can see there's a significant increasing about 700%. It's because of the cash inflow from the loans and borrowing about 364 million. And for the next year, the financing cash flow become a negative value. It because of the cash outflow for the repayment of loans in 2016. And for the next year, it's still a negative financing cash flow. It because of the cash outflow from borrowing. At the year 2018, the financing cash flow are significant increasing. It because of the drawdown of loans and borrowing about 1 billion and 700 millions.
Hi everyone, so in this part we'll be looking at the prospective analysis for financial year 2019. First of all, I would like to briefly explain on prospective analysis. It is actually a way for us to forecast the future performance of the company based on the historical data and the past performance of the company. We wanted to know what is most likely to happen to the company in the near future. So the first step in prospective analysis is to extract the prior year's financial items from the financial statements. So in this assignment, we are using the prior 4-year performance to do our forecasting for year 2019. These are the key items that we extracted from our income statement, and we also extracted the gross PPE and long-term debt from our balance sheet as well. So after the extractions of the past year data, we shall proceed to the step 2, which is the forecasting assumption. So we will calculate the sales growth and the gross profit margins and the expenses portions for each year based on the data that we extracted from step 1, and we get this percentage. After that, we will sum up the percentage and divide it by 4 to get the 4-year average percentage for every assumption. And this assumption percentage will be used in our forecasted income statement later. So this is the projected income statement that we made for 2019. These figures are actually all calculated based on the assumption that we made just now in step 2. So for example, you can see that sales, you may refer to note 1. We expect that the sales will increase by around 17% compared to the sales in 2018. And for the gross profit, we are not comparing with the previous year, but compare it within year. So it is based on the sales. We assume that the gross profit is around 20% out of the sales, and the selling, general, and administrative expenses will be around 8% of the sales. And the depreciation and interest expense is calculated based on the previous year data. So depreciation is around 9% on the gross PPE of last year, and interest is around 11% on previous year long-term debt. And the income before tax also compare with the last year. And for the income tax expenses is actually based on the income before tax. And we assume that there will be no income or loss from the extraordinary items and discontinued operations for the projected year. And after we have done all this calculation, we can do the plus and minus job to get our net income. And for the outstanding shares, because the company did announce that they will have a 1-to-1 bonus issue to their shareholders, so we assume that the outstanding share will be doubled up in 2019. So you can see that this is the trend forecasting for the company. The company is actually experiencing growth every year, a positive growth every year because there are no negative. So it means they are actually growing every year, but at a different rate. You can really see a trend or a strong pattern here, but we know they are experiencing positive growth every year. So to have a better understanding, you can look at here. So the sales of the company, you can see, is actually growing year by year, but at a different rate. So here in 2015, they only increased a little, but in the 2018, the sales increased a lot in percentage, and same for the gross profit and the net income. And you can see that the depreciation and the interest rate and the income tax expenses are having significant changes in the recent year compared to the earlier year. So this significant change will be explained more by my friend in part 3. So that's all from me. Thank you.
Next, I will continue my part, which is observation about pattern of graph in task 1 and task 2. Task 1, we already know that the graph shows the statement of cash flow for the top glove corporation Berhad, and task 2 is about the prospective analysis for the company. We already taking the graph for the operating cash flow in task 1 and investing cash flow, financing cash flow from the task 1, and we taking the trend forecasting for the task 2 to observe the pattern of the graph. Since depreciation expenses is calculated based on prior year gross property, plant and equipment (PPE), increase the gross PPE as much as 566.33 million in 2018 will project a significant increase of depreciation expense in 2019. And we found that the graph for interest expenses is the same direction with the graph of financing cash flow. For example, the financing cash flow in 2017 is increased to 2018, while we can observe that the interest expenses, which is the purple line graph, also shows the increases from 2017 to 2018. This will show that the financing cash flow and interest expenses will have the positive relationship, which means that while the financing cash flow is increased, the interest expenses also increase. And the next one, forecasted interest expenses in 2019, which amount of 156.83 million, is a lot higher compared to previous year. It is because it was due to the increases in obtaining long-term debt in 2018. High interest expenses in 2018, which is amount of 35.321 million, has dropped up percentage of interest expenses prior year long-term debt from 4.777% in 2017 to 27.17%, causing the 4 years average as percentage to increase to 11%. We also observe that the amount of financing cash flow in 2018 is the highest among the 5 years, which are 151,000 due to financing activities and the long-term debt from the balance sheets. From here, it shows that the long-term debt means that the company is borrowing debt from creditors or bank, and it shows the cash inflow. Therefore, the financing cash flow is become the highest among the 5 years. And based on the graph, we can see in 2018, the financing cash flow is the highest among the 5 years. And the next one, the investing cash flow in 2018 shows the negative amount, which amount of 1,696,456 ringgit Malaysia. It is due to some reasons, such as huge cash outflow on acquisition of subsidiaries that occurred this year. And the next one is influenced by the cash outflow from the purchase of property, plant and equipment. This is the graph that why we say that investing cash flow in 2018 is the highest compared to other years. And in 2018, the gross property, plant and equipment from balance sheets also shows the highest amount, which is 2,064,817. And the next point, the graph of financing cash flow, the cash flow from positive amount 262,035,000 in 2015, and it changed to negative amount 328,028 in 2016, and it also increased a bit to 205 and 333 ringgit Malaysia in 2017. And this is the graph shows that in 2015 the amount is positive, and 2016 and 17 the amount is negative. And it also can relate as for the task 2, which is the interest expenses. The interest expenses also decreased from 2015 to 2016, but it also increased a bit from 2016 to 2017. Here we can analyze that the graph of financing cash flow is because the cash outflow from repayment of loans and borrowings, and it causes the interest expenses, same as the situation for financing cash flow, as the cash outflow repay loans, causing the fewer interest expenses. And next one, the growth percentage for gross profit margin is decreased from 21% in 2016 to 18% in 2017, while the operating cash flow also decreased from 2016 to 2017. The reason is because the operating cash flow decrease means that the less cash inflow to the company and causes the less profit to the company. So the gross profit margin also decreased. Okay. And for other category, there is no pattern between the growth percentage and cash flow, as the graph shows that it's inconsistent direction. It cannot determine the relationship based on this graph.
Lastly, we will sum up all the information that we have created so far. Top Glove has been known as the world's largest manufacturer of gloves since back in 1991. As we can see, their product range not only covered for examination or surgical gloves, but also for food handling gloves and other products such as dental dams and exercise bands. Throughout our research, this company has shown a lot of positive development, including the acquisition of subsidiaries in year 2018. Top Gloves might expand their business even further and enable Top Glove to emerge to the world's largest surgical glove manufacturer. While our future forecasting also aligns with the fundamental of this company that shown a greater prospect in the next future or the next coming years. Thank you.